Well, I think the economy itself should be okay. I think it's going to be strong in the first half because of income tax refunds. So I think we will see a pickup in growth in the first half of the year, and then it's going to fade because we really are short of workers. For the market, we still probably need to see a shock to cause a big correction here. Eventually we will have some shock. Valuations are very high. But I think a base case is the equity market keeps on moving up, probably broadens out a bit beyond the Mag 7 and it continues sort of broadening out to other sectors. But for investors, the real thing is, how much risk are you carrying? Because these are expensive stocks at this point. And I think really the resolution for 2026 is rebalance because, whatever happens to returns, the risk level is pretty high here.
Are the earnings that we see out there, I mean, the earnings in 2025 have been really, really strong here.
Yeah.
Are they strong enough as you look forward to kind of support this market?
Yeah, I think they should be. I mean, it's a as I said, it's a moderately growing economy. So long as we avoid recession, one of the things that I'm seeing is a fair amount of weakness in wages. I mean, there aren't many available workers, but workers still can't get a pay increase. And meanwhile, companies are installing AI. Now, I don't know if that's making people more productive or not, but they say it's making them more productive. And so productivity numbers are going up because you've got fewer workers and producing more output. And that helps corporate profits too. So overall, I think the profit picture is pretty good. I think the rate picture is pretty stable, and that should support the stock market, barring some shock. But of course, there's always a potential for a shock.
We start strong on Monday. David Kelly with us for an extended conversation. He drives J.P. Morgan Asset Management with all of their strategy. David, one of my great insights, and folks, on my last 2 days of the year here, I'm really going to look back here. One of the great insights this year was Nancy Lazare, who David and I know for years with Ed Hyman. Nancy's up in Minnesota with Piper Jeffrey. David, she just said, look, it's an economy where there's an odd job creation. You led on this 2 years ago. You're the one that said, get used to non-farm payrolls under 100,000. Yep. Do you adjust like Jerome Powell? And are you giving me a real 3-month moving average now that's a negative statistic of payroll growth?
It's very close. I mean, I think we're talking about somewhere in the range of -50 to +50 is the trend rate. It might pick up a little in the early next year, but we're out of workers. I mean, we don't have good immigration data at all. The government stopped producing a lot of data that we need in order to figure out exactly what's going on with the growth in the working age population. But as far as I can tell, it's shrinking. And it's very hard to grow jobs when you're shrinking the working age population. But that actually has a feedback loop in the overall economy. I don't know if you remember Say's law from your economic theories classes, but the idea that supply creates its own demand. If you pull back the number of workers enough, and you don't open a restaurant because, hey, you couldn't staff the restaurant, so those jobs don't get created. The meals don't get served. The houses don't get built for the people who aren't around to live in them. So the lack of labor supply is slowing the economy in itself.
Right. Say's law, Paul, at Trinity College is they open the Guinness Brewery.
Yep.
And if they manufacture the Guinness, it somehow gets consumed. That's Say's law out of David Kelly's Ireland. I look, David, at the job economy. And I look at the worry out there, and to me, it becomes a political monetary policy. Can economists ignore a negative non-farm payroll trend?
I think I think if it continued into the first 6 months of next year, then I think the Fed would ease earlier. But I think we'll see a little pickup, as I said, because of income tax refunds. I think we'll see a pickup in growth, and I think that will stench the bleeding for a while. But then, maybe later next year we do get rate cuts. But I want to make it clear, rate cuts won't fix anything here. The problems that this economy faces have got nothing to do with interest rates, or interest rates being too high anyway. So yes, it may force the Federal Reserve into cutting more aggressively later next year if we don't sort of put some more artificial stimulus into the economy, which we may well do.
David, at J.P. Morgan Asset Management, how do you guys think about alternative investments?
Mm-hmm. We think a lot about them. We're very conscious of the fact, you're just talking about how good a year it's been for the stock market, and the bond market's giving you positive returns despite a fair amount of inflation. That means that a sort of a 60-40 stock bond portfolio is pretty expensive. And people really need to diversify and reduce risk. But one of the key ways they can do that is investing in alternatives, things like infrastructure, transportation, real estate, also private equity and private credit. But you've got to know who's managing that money. But we definitely believe that all investors need to think about having some alternatives in their portfolio beyond the public markets, because the public markets do have a certain amount of risk. And by the way, there's also a lot of opportunity in private markets. The companies don't want to go public. And so a lot of the explosion of ideas around technology and AI and biotech and so forth, they're all occurring in the private market space. So you really want to be able to access some of that. So yeah, I think it's beyond time for people when people can just afford to ignore alternatives. I think people really need to think about their alternatives as they go into 2026.
So, David, I mean, I can sit here in a 2-year treasury and get, 3.5%. That's a nice coupon relative to the last 10 or 15 years. Is that good enough in the fixed income space, or should I be taking some credit risk here?
I wouldn't take too much credit risk. I think I'd want to have maybe a little bit more duration than that, but not much. I don't think there's much money to be made in fixed income, but I think that it does help stabilize a portfolio. So I wouldn't be underweight fixed income. I wouldn't take much credit risk because credit spreads are really tight. And if we do have a recession, then these credit spreads are going to blow out, and you're going to get hurt. So I just don't think you're getting paid for taking risk in the bond market.